My name is Dave Silliman. I'm the CEO of Easy Do It Opportunity Funds. We're going to be talking to you today about opportunity funds, opportunity fund structure, what you need to know as a business, and how to take advantage of this Opportunity Zone program. A little bit about us. We've set up more funds than any other entity in America in this Opportunity Zone program. We've set up a fifth of the entire market space. We've set up all but 5 of the business-based funds that are out there right now taking advantage of the program. So we've been awarded, recognized all the way across the board. Our funds have been written up from everything from Business Insider to Forbes. So this is something that we're an advocate about, we're passionate about for small businesses, and we want you to continue to keep watching this to learn more on how your business can take advantage of Opportunity Zone funds.
Today, my name is Jeff. I am with Crowdcreate, and we are going to do a deep dive into qualified opportunity zone funds. What is it, and everything you wanted to know about the real estate side as well as the business side. I am based out here in Los Angeles, California, and I was introduced to David, who is absolutely an expert in terms of qualified opportunity zone businesses. And if you'd like to introduce yourself, David, that'd be great.
Sure. My name is Dave Silliman. I'm the CEO of a company called Easy Do It Opportunity Funds. We set up turnkey opportunity funds. Our bread and butter is working with businesses in this particular space. A little bit about our background real fast. With the second funds in the country open, we've opened up more funds than any other entity in America. 2 of our funds recently were recognized being in the top 25 for fund managers in the country. Easy Do It itself was recognized being in the top 10 for QOZ specialized fields. But we've just been at it since day one. And we've had the first business funds, first stock funds, first cannabis funds, first blockchain fintech funds, the second venture capital fund now to launch. So we're just kind of in the space and really passionate about it, and especially from a business side standpoint.
So from high level, we've been reading a lot in the news about qualified opportunity zones. Everything, the press is constantly talking about. So on a high level, can you give an introduction on what the benefits are across, all asset classes, not just real estate, but also businesses, and what are the tax benefits?
Yeah, so basically the way this is a program that was stuffed into the TCJA back in December of 2017. And then basically the way that it states is that it gives investors who have capital gains an opportunity to roll those capital gains into what's called a qualified opportunity fund. And that fund then has to invest those rolled into capital gains into what are called qualified opportunity zones. There's 8,700 plus across the country, all 50 states, Puerto Rico, the US Virgin Islands. The state CEOs and the governors got together. They looked at census tract data, low income tract data around surrounding populaces, and basically put together these designated zones that says you're either in a zone or you're not in a zone. As a fund, it has to make investments into those entities, whether it's business or real estate, in those zones. So it does have some stipulations. It's a program that it was announced in April of last year. So we're talking, this is brand spanking new of a program. And the first set of guidelines, the first initial 4 pages came out in June. The second subsequent guidelines came out in October. And then we had just the concrete guidelines, this next wave that just came out in April. And so it's a government-backed program. The way that it works, real simple. It's a tax program for investors with capital gains. A really simple example, say I got a $100,000 capital gain. I roll it into an opportunity zone fund. I have to hold my money in that fund for 3 different periods of time. The longest being a grand total of 10 years. So from 2019 to 2029 is the 10-year window. The language reads that if I keep my money in that fund for that 10 years, that I get a full step up in basis to fair market value. If I keep my money in that fund for that 10 years, during that 10-year time frame at year 5, and then also at the year 7 mark, I get 2 additional step ups on the $100,000 that I put in. So I'm going to have to pay tax on that money, the $100,000. So if I sold Bitcoin or stock in Facebook or something like that, I'm going to pay tax on that. Instead of paying it this year, I'll pay tax on it from 2026. And for the $100,000, if I keep my money in the fund, I'll pay tax on $85,000. Let's say the fund grew in value to 500. I'm going to walk away with 415 tax-free as an investor at the end of 10 years. And then I can exit out of the opportunity fund, or I can choose to stay into it. At that point, everything is 100% tax-free growth. There is an expiration date on the funds themselves. It's 2047 as it stands right now is the end of the program, 2037 is the last year that an investor can roll their capital gains into an opportunity zone fund. For 2019, two big dates are June 28th, which is a huge date for the first real testing, I think, of how this market is coming together. It's your capital gains from 2018. In certain circumstances, investors had basically an extension to December 31st of 2018, which gives them 180 days, because the investors themselves, the moment you do in that scenario of selling Facebook stock, for example, the moment I sell it, I'm realizing my gain. And so now my time clock starts as an investor. So I have 180 days. And so the first 180-day real time clock is June 28th. And then the big push for the program as it stands right now, the way the language reads, is for December 31st, 2019. 2019 is a big funding year in the eyes of the government for rolling these capital gains into these opportunity funds. And 2019, as long as you have it in, and by 2019, you have a 7-year window for your total of a 15% step up in basis. You get 10% at year 5, another 5% at year 7. So 2019 is the last year when you look at 2026, when you count 7 years, that you get that advantage. If you invest in 2020, you're only going to get a 5-year step up in basis on that. So 2019 is a really big year for the Opportunity Zone program. Effectively, this is the birthing year of it. So it's a really, really unique, advantageous tax program to be able to help capital raise and deploy money back into these distressed, lower income areas. And not all of them are that way, but a good chunk of them are.
And so I know there's quite a bit of events that are going on, mainly these Opportunity Zone conferences and expos, and a lot of it is on the education side. And a lot we've been hearing as opportunities for people are to invest in everything from real estate to now what's become the business side of it. So can you explain the impact that qualified Opportunity Zone businesses have, in addition to also the real estate aspect of it, and how exactly it could have a bigger impact than what we know?
Great question. I look at businesses very unique. When you kind of compare, let's say, apples to apples, the real estate market, first and foremost, you've got a little bit of a problem in the way of returns being capped to investors, meaning that every single real estate deal is going to have some sort of ceiling. If I develop a 300 unit of a family complex, I'm not going to get a 301 rent. I'm not going to get a 350th rent. The rent that I do receive or whatever I sell for is going to be contingent upon whatever the local rates of inflation are, cost of living, etc. And my ability as a developer to be able to increase those as inflation increases, hope that there's enough equity in the future to be able to roll out and pay my investors back. Businesses are significantly different in how they can operate in opportunity zones. First and foremost, I think that they're going to be a lot more impactful, long range, than what real estate are going to be. Number two, there's no cap on the ceiling for a business. You can have a business that's kind of trucking along today, and then all of a sudden something happens, a catalyst change, a personnel, a product change, something major happens that causes this huge explosion all of a sudden in growth in business. Now you've got, instead of looking at the average real estate deal being a 12 to 17.5% IRR, some rare cases a little higher, but not much. Businesses are looking at an X factor rate of return. There's a lot more businesses than what there are sustainable real estate deals. A lot of real estate people have jumped into the opportunity zone very early on. They looked at it, and in some cases they're using opportunity zones, opportunity funds as a method of armor rolling and polishing a turd, and that's not what these things were designed for. Businesses where real estate causes issues with gentrification, meaning that as a new development gets built, this new development increases the cost of living, it increases the prices, increases rents, and then it causes the people that are in that area, yes, it creates short-term jobs, but however, it causes gentrification for those that are living in that area. Whereas businesses have a tendency to hire typically people that are going to be long-term, they're going to be people that are living, working, playing, breathing, sleeping in those areas. So they're the catalyst to the gentrification issues that this program is going to be plagued with, especially from the real estate standpoint. Businesses have an easier exit strategy. Most of the real estate deals are completely contingent upon future economics. What are the costs to borrow, costs to leverage, costs to liquidate, the availability of supply and demand issues. businesses, most businesses, unlike real estate, typically are a different structure at their core as a formation, which allows for a fund to make an investment a lot easier, and also to be able to create a cleaner exit strategy. Whether it's an exit strategy that involves, an exchange market, or whether it's an exit strategy that involves whatever the investment position is being repurchased back by the business over the time period in the opportunity zones. When you look at the number of mutual funds, for example, with businesses, you've got 15,000 plus mutual funds investing in 4,800 publicly traded companies between the Dow and the S&P. When you look at how many businesses that there are, there's more than 4,000 businesses just in your location alone, let alone how many businesses that are in these areas that are, right on the verge of being able to be explosive and have struggled being able to raise capital, struggled being able to really kind of get through that next glass ceiling for growth. And that's where this program can come in. The beauty of it is that it only has a few sin businesses associated to the program that you really can't touch. That's massage parlors, golf courses, ABC liquor type stores. Beyond that, in the business sector, it's wide open. Opportunity funds can be, impacting everything from technology to energy to gas, oil, to manufacturing, to mining, to transportation, to fin technology, to bioengineering, A to Z, that can be done in these opportunity zones. It's going to bring jobs. It's going to create, a better economic situation if the program in this space can understand the power of what businesses can do. Up until recently, virtually everything was associated. Less than 2% of the entire market space as it stands right now actually is associated to using this program related to businesses. All the way at the highest levels, with the SBA, for example. We're doing a lot of educational consulting with the Small Business Administration on how this really does and impact both large-scale, mid-scale, and small-scale businesses. The language kind of was updated in April and effectively took the handcuffs off the program, really. I mean, it changed what was, we call it the Amazon effect, but it was a 50-50 rule that had originally said that 50% of the revenue earned from the business had to be generated from sales within opportunity zones. Well, logistically, that's a nightmare for any business to have to try to say, I sold to John Doe over here, Jane Doe over here, and I got to match their addresses and scrub in a database. They got their sense together, the government did, the legislators, and they updated that here in April. So we're talking just 30 days old. So for businesses looking at getting in this space, you couldn't ask for a better time frame. But they've changed those to now it's just 50% of the hours worked by employees have to be worked inside of opportunity zones. And they gave strong verbal language on being very, very aggressive and suggestive and saying, hey, use this program for startups. So for businesses, it's the sustaining factor, I believe, long-term for investors. Yeah. I think it's just getting started.
So as a whole, everyone, these qualified opportunity zones are an opportunity for people to take capital gains, reinvest them into these specific zones that allow economic development. And what would you say, Dave, is a lot of the hesitation with businesses in general? I know the new regs came out and real estate was really the first asset class to move forward. But in terms of business, can you walk through the steps to setting up a qualified opportunity zone business and how people can effectively, get started?
Yeah, absolutely. So really, the first step is saying, okay, is my business in or out of an opportunity zone first and foremost? If you're not in an opportunity zone, that would require that you have a location as a business in an opportunity zone. If you're in an opportunity zone, then by default, you're classified as an opportunity zone business. Now you get into the intricacies of how is that business itself structured? Or is it a partnership? Is it a sole proprietor? Is it an S Corp, C Corp? That's going to be critical for how this program deploys with businesses. They're going to have to determine a value and be willing to sell a piece of that business equity to an opportunity zone fund. Now, a business can set up a fund, which can be a secondary entity that the investor invests into. For most businesses, the two main type of structures that we're seeing in the marketplace right now are either going to be your partnership type structure, which is probably 95% of the market space, and then you're going to have a stock-based C Corp type based structure. The partnership shape structure makes sense in real estate deals. It makes sense when you're trying to raise, a small round of money between friends and family, and you're trying to, manage that. Your own capital gains is a piece of it. When you're trying to raise outside capital, then you kind of get into some of the nuances of what it's like with partnerships, exit strategies with partners that want to leave early, cash calls, etc. Where most businesses are different is they're typically a stock-based. They're typically C Corp. So the underlying business is just going to issue some stock. The fund is going to make an investment, and it's a pretty simple program. At the fund level, if the fund is going to set up itself to be an opportunity fund, it's got to understand that the moment that you are going to talk about and solicit and raise these capital gain dollars from people that you and I don't know, it's no longer about the simple one-page IRS self-certification form that a lot of business owners have this misconception that all I've got to do is fill this thing out and now I'm an opportunity fund. When you capital raise, it has nothing to do with the IRS. It has everything to do with the Securities and Exchange Commission and how you structure our offering, whether it's a Reg A, B, C, D offering, the limitations on the type of investors, accredited versus unaccredited, the number of investors. So you're playing with a different set of rules from a structural standpoint. You need to have certain documentations like a private placement, a business plan. You've got to know your numbers. Do you have a strong team of people? If you're setting up a fund and investors are trusting you, in some of these cases, to kind of put things into perspective, the average round A is $35–40 million. The average size opportunity fund now, according to the NCSHA, is $250 million. So when you look at something like that, if investors are going to be trusting you just because you're a small business owner or you've got a business, what's your experience in actually managing a portfolio type fund? Are you going to be a single asset, multiple asset? Meaning, are you going to only invest in your business, or is your business going to be the starting point and you're going to use it as a catalyst to invest in other businesses as well? Different classifications and how the legal documentation has to be verbalized. So it boils down to really just the atypical strong fundamentals that private equity, angel investors, venture capital investors, the transparency, who a fund brings in third party wise. I think when you look at the opportunity fund space, all of them, whether it's real estate or business, they both have the exact same starting point. Not one of them has prior performance history where they can say to you and me, hey, we've got a background for the last 5 years of generating a 10% return. None of them have it. They're all starting at ground zero. At best, they have, hey, our management team, our somebody on our board has a background. Most of these small businesses don't have that in the way of what investors would typically be looking for in an investment vehicle. So a willingness to integrate third parties like proper fund administration, proper tax, proper legal, accounting, auditing, those type of things. For businesses, it creates transparency through credibility by riding on their coattails, especially if you bring in somebody like a KPMG or a PwC, depending on the level of where the business is at, what they can afford, etc. Where your credibility lacks, you can piggyback on with a strong enough team. That's what these investors are looking for. Being willing to build something to a higher standard. Prime example, they're all of these opportunity funds are all private equity. Not one of them has actually gone to becoming a publicly traded fund, either through the NASDAQ, Dow, or even for the penny stock for that matter. They're all private, in equity investments. They're all considered to be ultra high risk alternative investments for investors. So knowing that you've got a baseline minimum standard that, usually is just, a lot of people are just term sheets or a simple little offering circular. But then you've got a varying degree. And the SEC has come out through FINRA with checklists that say, hey, if you really want to be transparent, if you really want to have somebody vet this thing and look at it and underwrite it and broker it out, you can build to a higher level of transparency. I think that as a business, having that willingness to do that, I think adds an immense more credibility. It shows the investors that, hey, we're quality as a business. We've put an immense amount of effort, energy into showing you that you can trust this as an investment. And that's what's needed in this space. What we're beginning to see from the investor standpoint now is more and more investors that have, RIA experience. They've got venture capital experience. And now these are the type of investors that are beginning to move into the market space. What we still are waiting to kind of see, and I think this is where, as funds and this market space of funds begins to develop, because you got to keep in mind, legitimately right now, I've read reports say there's thousands of funds out there raising hundreds and hundreds of that those are well exaggerated. If you look at the CoStar list, the Novogradac and Company list, the NCSHA, these are reputable lists of funds that are actively out there pursuing, soliciting, trying to raise on these different directories. They're only showing, 137, 140 funds, 32, 33 and a half, 40, $35 billion max cap. So we still have a very, very unique marketplace. And with the timing of the new regs, with where the money is at right now, beginning to look at this, I think it's prime time for businesses to look at really taking a hard look at setting up a fund.
Can you highlight some of the examples of businesses that are primed for this Qualified Opportunity Zone fund, and people that have even approached you, and maybe an introduction to your business?
Yeah, absolutely. I would say, we had the first business-based fund in the space opened. It was actually a franchise-based fund. It's called the Loyalty Brand Fund. We set it up for a gentleman by the name of John Hewitt, who was the founder of Jackson Hewitt, and then also went on to found Liberty Tax. Has now since gone on and is becoming very successful in another brand of taxes in franchising. And so they were a successful business base. They were the first business opportunity fund, but we've gone on to since we've done cannabis, we've done blockchain. Right now we've got a really strong business fund that's it's the largest cannabis lab testing facility in California, for example. We're doing a fund called the Fortified Fund, and it's fortified.fund is the website. That's a precast concrete technology that's 30 plus years old overseas, coming to the United States for the first time, doing these stronger homes to be able to survive these hurricanes and storms like that. We're doing farming, for example. We've got a fund that's called the First Harvest Fund. That's indoor. They've got basically a better mousetrap on how to grow faster, better, more quantitative vegetation in the farming sector. We're doing a venture capital fund, for example. That fund is called Verte, OZ, and all their focus is focusing on investing in small businesses. So we're seeing a lot of that. We did a blockchain fund that had 2 fintech investments that is widely successful at the moment. So we're seeing a lot more. It's been very slow. It's been like trying to scream from the mountaintops for the last year. Hey, businesses, businesses, businesses. But it's just now beginning to kind of come into play, and it's wide open. That's the beautiful thing about this program. I mean, if you look at it from a business perspective for a second, and context is always king, you're talking about a financial program that is laying out an entirely new financial sector backed by a guaranteed tax program with the federal government, putting investors on a time clock where you can come in as a business and be the first and have an opportunity to establish relationships that you would never, ever have an opportunity. I mean, you and I would not be talking had it not been for opportunity zones, opportunity funds. And it's such a beautiful opportunity right now for businesses that kind of see it and get it. I always tell people there's a time, place, and season for every harvest in life. And you've got a fertile soil right now that is ripe for businesses to come in, be the first. Come in and be the first real, energy, the first real, like George Foreman, his sons, for example, they set up an opportunity fund with gyms and that kind of athletic nature as a business. It's wide open.
Yeah, maybe we can talk about some of the key players in this space. I know Revolution, Steve Case, who's the founder of AOL, is actually starting an Opportunity Zone fund and business. But is there anybody else, key notables like George Foreman's son, for example?
Yeah, George Foreman, George Foreman II Jr. and G3, his 2 sons, for setting up a business. You've got a lot, it's not so much necessarily in the business sector. I would say that people like Steve Watkins with the Entrex Capital Market, for example, which is very, very business heavy. I would say even from the real estate side, people like Craig Bernstein, Lance Groth with Growth Opportunity, 1030 Growth 1031. There's so many people. Steve Glickman with Develop LLC. He's one of the key architects of the program. But it's beginning to kind of, the people that are being regular voices and that actually have experience versus just regurgitating information, people that have taken the time to read through the bills, understand this from a contextual side and also from a literal standpoint of deploying these things. Those are the type of people that are now beginning to really get recognized more and more. And you're seeing it kind of go from this down to 10, 15, 25 real key people that are just huge advocates and voices. And I think the business sector hasn't even gotten started yet in advocation and a voice for the program.
Nice. What are some of the frequently asked questions with these qualified opportunity zone businesses, and what would you, advise to getting started?
We get a lot of questions on structure, understanding, okay, hey, as a partnership, we're not going to get taxed. There's double taxation with corporations. Yes, that's true, but you've got the TCJA that gave a flat tax rate of 21%. A lot of these opportunity funds are going to be able to kind of whittle that down to virtually no corporate tax in some cases. The little bit that they may pay, when you take a look at the advantages of structure with the C Corp and what you can and can't invest into legally versus a partnership, you're cutting your nose off to spite your face when you set up an LLC structure. So we get a lot of structural type questions. We get a lot of questions as far as, what about my own capital gains? Let's say I've got money, I'm a business, or can my business put my own, let's say I've got business capital gains. The capital gain market's $6.8 trillion last year, according to the IRS, for unrealized capital gains. When you look at that, you had approximately 4.2 trillion and 2.6 trillion of that. 4.2 is your individual gains. Your $2.6 trillion is your corporate capital gains last year. We get a lot of questions on what about rounds? Can we look at, in our business, we've raised capital before, we've done them in staggered rounds. Is something like that applicable to opportunity zone funds? The answer is absolutely yes. Businesses working with different locality, municipality, economic development agencies. That's something that we get questions about all the time. A prime example of an opportunity fund that was quasi real estate, quasi business is we built a fund called the Gateway Opportunity Fund, and they were able to directly work with the city of St. Louis to get like 3.5% sales tax rebate for the tune of like 99 years back to the opportunity fund. It was something ridiculously crazy, well beyond the expiration date of the fund itself. But you've got these municipalities that are bending over backwards saying, hey, we can't get into it. We can't set up a fund. Few and far in between will these municipalities themselves be able to set up a fund because they're not structured that way to be able to do that, setting these things up. So they don't have a choice but to work with existing opportunity funds. Where businesses come into play at is they say, okay, if we can work with the municipality and they can understand the magnitude of what that can bring to the business, it benefits the municipality in the way of increased jobs. It's a sales pitch for the local politicians for the municipality to get rehired. They themselves have got local investors that live, work, play, built the business locally, have got capital gains, and would rather reinvest those capital gains locally than into something that's intangible to them 3,000 miles across the country. So there's huge advantages in working with those economic agencies like that with businesses, and that's something that we get asked about. What do I do to capital raise? How what documents do I need? As a business, do I need to be profitable? How fast do I have to start generating returns back? Are there alternative methods to structure an exit strategy with businesses? Like, for example, a lot of businesses that we work with will structure a very clean repurchasing exit strategy over a 10-year period. It lowers the fund's assets under management. It works on like a top line gross. For every dollar invested, they're going to agree to pay back $2 on a monthly basis, for example. Dollar buys the equity back. Dollar creates cash reserves, lowers the assets under management, helps to cover the investor tax bills that are going to be due, because the investors are more than likely going to be looking at 2026, coming back to these opportunity funds saying, hey, I've got a tax burden that's due. what can you as a fund do? How do I get money back out of this thing to pay this tax bill? So there's a lot of ways that businesses have a cleaner advantage than what real estate does. And so we get a lot of questions like that on businesses and opportunity zone funds.
That sounds good. And David, what's the best way for people to contact you?
They can visit our website at easydoit.com. That's EAZYDOIT.com. They can email me at info@easydoit.com. I'm on LinkedIn. We're on YouTube. We're on social media. My direct number is 757-319-2103. So, we're open to, doing consulting phone calls. Our service that we offer for businesses and opportunity funds in general is a true turnkey service, to where we actually start to finish develop a fund with all of the proper foundational, the legal, the financial, the entity, the administration, and then the marketing, branding, video, web, the visceral aspects, the launching of the fund, the PR. We do have dedicated funding partners that have first rights of refusal to the funds that we build. So every fund goes and now gets reviewed by these funding outlets first before we even really kind of push it out there to the market. We do a lot of support for the funds. We do a lot of education. We're working with doing a lot of consulting with the SBA and other groups right now. We're an advocate in the space, and we're a strong catalyst and a very, very strong connector in what we do. Being able to bridge the gaps, being able to integrate, additional team members, and just having an understanding of, the different structures and really kind of how to take advantage of this program to where we make the process literally, easy. We're developing funds in less than 3 weeks, start to finish.